Hello, everyone, and welcome to another edition of Bank Talk. This is Ethan Heisler, and I'm here with Van Hesser.
Hello, everybody.
And we've just finishing up the third quarter earnings, and it's, I guess, not a lot of real new news. I mean, some new news. I mean, I did think that there was some interesting indications that maybe deposit beta on the consumer side is beginning to stir a lot more. Obviously, we've seen that on the wholesale side and the commercial side for some time. That's interesting to me. I think there's been a lot of talk, this great media headlines about customers pulling money out of non-interest bearing and putting it into interest bearing. I think we've been highlighting a lot of the data that kind of in the bigger picture scheme of things, we're still sitting with much higher levels of non-interest bearing deposits in the banking system than we've historically seen.
Agreed. You know, I do feel like though we're at a tipping point here, Ethan, and you're right. The industry has been watching this for probably a couple of years now. And it all of a sudden starts to feel like it's starting to tip. And as we all know, bankers have been waiting for the rates to rise for all the reasons that we know that to be generally good for banks. We're also aware that there's a fuse on the benefit of that. And I think we're kind of reaching that point now where asset prices have been raised. Deposit pricing, of course, is lagging, and there's lots of reasons why it's probably lagged more this go around than in past cycles, but it seems to now be turning, right? And so we're going to lose the benefit of being able to raise asset prices, still a very competitive loan market out there, and yet deposit pricing is really starting to move up. So I think this long-awaited benefit of a rising rate environment on bank earnings, the bloom is coming off that rose a bit.
I think there's definitely some headwinds here, Van, although I do think that the overall story here, when you have a GDP print today of 3.5%, and you've had the longest running expansion, your biggest challenges right now ahead are the concerns and uncertainty in the economy and the unwillingness of people to put on more risk at this point.
I think that's right? And that's probably a very healthy reaction. It's interesting, going back to bank earnings for a second, we definitely saw strong results across the board, but one very particular and interesting reaction, Bank OZK, right, the old Bank of the Ozarks, a big national construction lender. Its stock sell off 27% on news that it reported its second and third charge-offs, I believe, in 15 years in its commercial real estate business. This is a bank that's still earning 1.3% on assets, so still strong earnings absorbing these two charge-offs they had. But I think investors and the market reaction represented a couple of things. One is that clearly OZK has gone from a growth stock to a value stock, and that redistribution has been weighing on its shares. But I think, to your point, people have gotten, yes, it is hard to find fault with where we are economically. Very strong consumer, strong business, sentiment both commercially and on the consumer side at very strong levels. But this has been going on, meaning economic expansion, for a long time. People are wary of stretched valuations, wary of sort of the big ominous signals or catalysts that lay out there in the weeds that flare up. And so their reactions to certain events can be exaggerated, and that's what we're seeing in markets. But let's be clear, the fundamental backdrop here remains very, very healthy.
Yeah, and I also think, though, that the overarching driving theme here is people looking for yield. And so in such a market, it's very hard, unless you get to a stage where people would much rather sit on cash today than be invested. I don't really see unless something really dramatic occurs, and without that trigger, it's hard to see where this really becomes anything other than just a great, interesting buying opportunity for most people. Look at the way the stock market just bounced back. We are getting more volatility, but we're not really seeing the kind of events that we saw 10 years ago. You know, what's also fascinating is that banks were talking on the calls, and I quoted this in my last newsletter, but multiple people were saying this, that the competition for commercial real estate, the competition for C&I loans, leveraged loans, all of those loans are actually getting sucked into the CLOs, they're getting sucked into P&E, and all of that, the banks are actually pulling back from it, which is a healthy thing.
I think it is. It depends how you define healthy, right? So if you're a shareholder in a bank, I think you're still looking for that growth and hoping that you will get loan growth. And that leakage into the shadow banking system is going to stop. But it is what it is, right? This is a function of regulation post-crisis. The shadow banks are flourishing. I agree. A lot of risk has poured into that space. The good news is it's not in the banks. The bad news is it still might be there in the financial system.
Right. I thought, just to switch gears a little bit, let's talk about deposit beta, because I've been looking at this consumer deposit beta trends for a long time, where everybody's looking for, when is this consumer going to wake up? And I had a friend of mine who pointed out, looked at, he works at a money market fund. He said, take a look at prime funds recently. So, I mean, this was in our last chart deck. And you see that government treasury funds, the government treasury money market funds are basically flat, but money market prime funds have been increasing, and that gap between the two has been closing. That gap is closing because of mom and pop. Mom and pop investors are saying, I'll take some extra risk because prime funds are risky. You don't necessarily have to be at the buck. It can be below the buck. There's some volatility now because of the reforms. They'll take that because they'd rather earn the 2%, and you get the checking privileges. So this is the natural. This is what money market funds traditionally disintermediated the banking system out of checking deposits. And what we've seen since the financial crisis, and I had this also in this graph over here, since the financial crisis, checking deposits have been climbing while overall money market funds have been flat. But when you look deeper and you look at the decomposition of prime versus money market funds, you see these change, and that could be a sign that we might start to see the consumer. And you're right, if you're not getting the loan yield beta, because that's being retarded through competition. Right. And you're starting to see this competition on the funding side, margin pressures are coming.
I think you're right. That's what we've been, and that represents, right, on to the next phase, right? So the rate rise, we get a little bit of margin expansion. I think the industry bankers are thrilled that it finally arrived. There's a fuse on it, as I mentioned. Now we're in that second phase where some of those margin expansion is probably going to reverse.
Right. And then I thought, the broader message for investors today, if I was looking in the bank space, it's still a fairly strong performing sector, much more so than we were 10 years ago. There really aren't a lot of credit problems here, and the banks are robustly sitting on robust levels of cash, of capital, and actually even of reserves for loan losses, even at this stage of the cycle.
Yeah, I totally agree.
Well, now, that's a new one. We're all in agreement on our bank talk. Well, there you go. I guess we'll leave it at that. Thank you very much, everyone, for tuning in. We'll be back. This is Ethan.
And Van.
See you again. Oh, and Van, before we leave, let's just put in an extra plug for our bank symposium.
Thanks for mentioning, Ethan. Yes, we are doing our first KBRA Regional and Community Bank Symposium, a one-day event in Washington, D.C., November 13th, 1 week after midterms. Ought to be a very interesting time to be in Washington. We've got a terrific lineup of panels and speakers, all content driven. We'll look at an asset quality update, commercial real estate, consumer lending in the U.S. We'll have a bank M&A panel. We will have an investor panel. And of course, lots of political and regulatory voices, including Yelena McWilliams, the head of the FDIC. Again, one day at the Willard Hotel in Washington, November 13th. Find out information on our website, kbra.com. Hit the events tab and you'll find information. We'd love to see you in Washington on the 13th.